Everyone to the Kendall Report, where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to talk a little bit about the tariffs, but we've got a big week ahead of us with employment, a lot of metrics coming out, and markets still in recovery mode to a large degree. So let's get into tonight's video. So welcome everybody. Sorry we had a little glitch when I was starting the previous version, so I'll get that deleted here shortly. So anyway, welcome. It's Sunday night. We're continuing on the daily videos and along with the Substack. If you don't have Substack, then get it. Go to kendallreport.substack.com. It's $8 a month. And we're going to take the annual subscription away. I'm working on trying to reconfigure everything in the channel. And so it's actually, there's an issue with something that's been going on with the payment gate and all that kind of stuff. So anyway, it's going to be $8 a month going forward after the next couple of days. So you can still get that 80 deal, I think, for the next several days. I've been really thinking a lot about what's going on here with the tariffs. You know, I've been, screaming, Jerry Maguire, show me the money. And there's rumors that they've got a deal with Japan. And I saw something, I think it was Kevin O'Leary said something. It really made a lot of sense when he was talking about it. And I know he's been, at Mar-a-Lago and is in touch with certain people in the administration. But he said something that made a lot of sense is, you can't do 60, 70 deals with, all these countries that, they're saying they have connections with and that they're coming. You can look at Washington and see, every day there's another head of state coming into the White House and meeting with Trump. So there obviously is some things going on. But he said something that made a lot of sense, is that and I've been saying the same thing, show us one deal, right? So, and the reason that you're looking at just the one deal is that one deal, that first deal, maybe Japan, is going to be the model for everybody else, right? So you've got to have a model. So once you get one deal done, you can go to all of the others. The EU, there's probably a core group of people setting China to the side here. The core group would, be obviously the EU and Mexico, Canada, India, and some nations in Asia outside of China. And what you're going to get there is you have the model. If you get that core group, then you've got all the pressure on China to do a deal. And I think Trump is being pretty brutally smart with China because he knows they're in trouble. We all know, we've been talking about it off and on for years. It just kind of fades in the background as is the Chinese real estate issues. I mean, they got empty cities. They've got all kinds of things going on. They have a little bit of a how's the best way to put it, like a revolt going on. And Xi Jinping, if he loses control there, that thing goes up pretty quick. So not saying that's going to happen, but Trump knows he's got him at the weakest point. And one of Trump's strongest negotiating points is when you got, it's sort of like a boxer, right? Once you get that good hit in, you smell blood and you get after it. You don't let them recover. And that's kind of what I think Trump's strategy is. Now, it may work, may not work. Well, we're going to find out how all this plays out. And I think that I also saw a little clip, I think it was like maybe 5 or 8 minutes with Ray Dalio. Typically, haven't agreed with Dalio for a while, but I've been kind of emphasizing it falls in line with what I've been telling you folks, as we're at the point where right now we have to deal with this stuff. I don't think all of us realize, if you look, and we've been talking about it as well, is how big this debt is, and that if we don't change something, we don't survive beyond a certain point. some people think that climate change is existential. I think it's the debt. The debt. It's getting all this spending under control. All this has to happen, and there's a window, maybe 3 to 5 years. And if we don't get it done now, then there's economic catastrophe that nothing's going to work. And so, hate him, like him, whatever, he's the messenger to try to make this happen. I don't know what's going to happen from that standpoint. But all of a sudden, let's talk about the markets for a few minutes. We've seen our database. I'll show you in detail here in a minute, but the short-term database back to 43% bullish. Last week, we were buying both hands, anywhere from 1,000 to 2,000 different stocks every day last week, virtually. So we've seen a big comeback in the database. We saw a little comeback in the intermediate. I'll go through all those details. But the reality is that we've seen at least market sentiment shift very quickly. And that doesn't mean that there's a low and a new high coming right away, but it does mean that the stability has come in, and maybe the Jerry Maguire moment is coming where you show me the money, and maybe the money will show up. And that may be the Japan deal. And once the administration gets that, you can guarantee the book tour will continue with J.D. Vance and Scott Bessent, whoever, right? There many people in the administration just running around talking their book. And that's the way it's going to be, I think, as we go forward. And I don't know what the outcome is. I'm not trying to claim I know the outcome. I'm primarily a quant and technician in the markets, and I have a macro view of the world, which usually goes through my reverse fundamental strategy that I talk a lot about. Otherwise, I have here's what the quant stuff is telling me, and then, is there anything out there that would facilitate that? Because ultimately, you have to have fundamentals to move to validate or to confirm the technical outlook or the quantitative outlook, whatever it is that you're doing. So everybody's is tied to the fundamentals. There's no way to escape that. So, so let's talk a little bit about this week. We'll see what happens with the tariffs to see if they get a deal. And from there, we could see a lot of good things happen or not. So let's go to some of the things that are coming up this week. We've got a fairly big week. I'm looking at the calendar here, and we're looking at, 80. This is an employment week, first week of the full week of the month. So we'll get, as we come into the end of the Q2, first month of Q2, and then we'll move into, and we've got Tuesday is kind of, we get the JOLTS numbers. We'll see what that looks like. I think the employment is going to stay very solid here. I don't see this really getting out of hand. And I was talking to somebody earlier, and we were talking about, how theoretically everybody's got this little scenario of the supply chains being disrupted and everything's going to start going up. But this was my argument with my rebuttal to that statement is, where's it at? We don't see that happening yet. I haven't seen it. It seems like that would be, everybody would be talking about it if there were 100 boats off of, outside of LA and trying to get into, getting into the ports and all that. I think maybe some of that's happened, but I think they're just shuffling the deck around right now. I don't think anybody wants to go there. So our perception is what we saw in the sickness days, right? When everything got shut down. That's not what's happening here. And what is happening, there may be some strategic movements of things, and some things are being held back and the so-called war, but in the end, everybody still wants to make money. So I think that's the play that Trump's making is, yeah, you want to block it, but do you really? And, how much do you want? How much cash flow do you want? And how much do you need? And so, but we're not seeing those kind of things from that standpoint. But as we go through, we got Case-Shiller, we got housing coming out. This is Tuesday, by the way. Wednesday, we got ADP numbers. They are what they are, 115 expected. But I'm just looking through, and then we also get PCE prices, right? So we got employment numbers, we've got PCE, got a bunch of stuff. I didn't look at the earnings, but there's earnings coming out as well that may be impactful. I think all the big stuff is out, but then you get into the payrolls are expected 125, and then the thing that we always watch is the continuing and the claims every week, and they've been the same, I think, for almost 3 years. 225 is the number, 215. It dips down to maybe 185, then back to 250, but that number's just in a range, and it's never changed. I think we had one time where it was a bit higher, and everybody panicked. Oh, this is it. So the whole scenario of at the moment of everything rolling over is not happening. So I still have expectations of Q3 and 4 of some of these elements start to come in at that time, but this is the reality on everything. Nothing has happened yet, right? Really, if you wanted to argue anything, tariffs are maybe 30 days old, and we don't even know the effects of any of this stuff at the moment. And if they're a negotiating tool, we're going to find out how good of a negotiating tool they are. Like I said, I'm going to keep close eye on Japan and see if that plays out. If that plays out and that ends up to be, we'll look at that deal and say, is this the model going forward? And they're going to present that same deal with some variables to the EU and to all the other players in that big core group. India, I know they've been talking with all of them. So I think India right now has on at least on cars, I think it's 110% tariff on any U.S. cars going into India. So I'm just looking at the last couple of notes I have here is that we also get factory orders. No one really cares, but it is going to tell us a little bit about manufacturing. That comes out on Friday. So let's set up the rest of the show here, and how we're going to go through tonight is I'm going to try to run through only about 12 minutes of my opening comments. Not a lot. I don't see a lot here. Maybe some things will come up during the week, but markets, like I said, have really just stabilized. So I'm going to go through the database. We'll go through the normal markets we get through and see where we end up on time. See if there's some time for some interaction, Q&A to come at the end. So let's go ahead and get into that. So it's kind of interesting. I brought up, I had this on screen, so I'll look at it. But this is a portfolio that I built. It's ETFs. It was built for, excuse me, it was built for one of our institutional clients, for conservative clients. And it's been pretty good from that standpoint. This is the metric. So those of you, I did just a quick comment. It's an appropriate time to put this out here. I ended up doing almost 3 hours on WaveTech on Friday during market hours the other day and beyond. And we had a bunch of technical issues. I'm going to download those. I was going to download them, but they hadn't given me the rights to download them yet. It takes sometimes up to 72 hours, and I think they just got up there, so I'll have to fit it into my schedule. But I'm going to pull those videos down, edit out all the breaks and stuff that happened. We had a bunch of technical issues, and I'll clean that up, and then I'll repost that. So if you were there and you wanted to rewatch it, it's coming up in the next day or so. I'm not sure when I'll get to it, but in the next couple of days, I'll get it posted out there. Okay, so but it's kind of interesting. This is a data sheet that I developed out of WaveTech, and I'm just about done. Anybody that uses WaveTech is going to get these files. You're going to have Claude. This is part of, I guess, my entry into the into AI and what I'm doing. But this is just taking one page of there's a report page that we have inside of WaveTech. I cut and paste that, put it in, and gave it some prompts, and it built all of this different technical outlooks, all types of different metrics and stuff. One of my favorite is volatility, and it's showing how this here is showing where the portfolio, how it performed versus the top line is what kind of risk relative to the S&P. So you can see it downsized a lot of risk, but it's a very robust report. And I think if there's a lot of metrics on here, and there's an executive summary that goes with this. And what's interesting about this, you can actually, one of the things that I've been doing with AI, I just want to get this in here, is taking data right out of our, this portfolio here. What came out of this was just, that whole sheet was developed by just these stats and these rolling returns right here. So that was able to generate all the information needed to build all the metrics and volatility and all types of things. So I'm excited that'll be coming out. I'm not sure exactly where it's going to be delivered just yet, but I've got a couple of tweaks. I ran into a couple of issues, but sometime in the next week I'll have that out. And then I'll also, I made some good progress on the fact sheets that we have on that I'm putting in the Substack as well, getting those out there. So good progress, not quite done, but really, really close. There's a couple things I need to make sure I don't put it out to you folks and it's not working, and I've got hundreds of you all calling me at the same time trying to get it to work. If anything, if I do release that and anything happens, then we'll just do maybe I'll do a live video and interact with people and do questions live. That may be the best way to handle it. But it's close, folks, I'm telling you. So, all right, so let's go ahead and get into the database here. So we're on an intermediate basis, we're up to 20.63% bullish. We were at 18, so we're still under 22 to even show we're getting enough traction. So that's still lagging. It's going to lag. Like I said, this is going to take multiple weeks before we get in a position. There's no way with 20% of the symbols in this database that is long on intermediate that we're going to run to new highs or any of that stuff. So what I can extrapolate out from this database into the real world and expectations looking forward, I try to tell everybody, I've had people tell me, oh, your database lags. It actually doesn't. It actually, once there's a certain amount of traction, and it's not about buying lows. This is different. This is about identifying sustainable trends, okay? And that's why the metrics of 42%, and there's 48, then there's metrics around 62 is the next level. But those elements have to come in, and I went through this the other day, that if you don't have the underlying foundation in the market to move it higher, you could argue all day long that the Mag 7 led the market. It did. That was one of the top end of the index. But if you didn't have a whole lot of, if you watch this channel, you know during that time that 60 to 70, around 75%, going all the way through multiple segments of 23 and especially 24 was that was a rally that wouldn't end, right? And we saw that 61% in the intermediate database. So the underlying factors and the underlying foundation for the trend was in place, and then you get the leaders and they rotate, and we've seen a bunch of the leaders crushed and kind of broken a lot of trends there as well. But there's just a lot of work to be done yet before we get in position for an intermediate sustainable rally. I don't know that we're going to get there. That number would have to get us above 42%. We're at 20. And if I go, I'll go to the daily real quick and we'll discuss both of the databases there. But we look at the daily is now at 43.38. That's above 42. So that tells us the bottoming formation literally in 1 week that we watched last week is there. I'm bringing up another screen here. Let me get out of the way. I didn't realize I was that much in the way. So what we're looking at from this standpoint, 43. But if we look down at this is entries, and this looks back on 2 weeks, we're looking at 5,700 new buy signals coming into the short-term database. All out of that entire period, there were only 116 exits. So we had blown everything out. We were at one stage around 10% on the short-term database, and now we've managed to we're back to 43, and so that is material from the standpoint. Let me. Bear with me a second here. I'm going to shrink down a little bit here. Yeah, so these metrics are good for the short term. We need to get over 42 on the intermediate to get more structure and more participants. It's sort of like it's a little bit different than the breadth. It just doesn't need to be up on a particular day or a bunch of stocks above the 200-day moving average. People use those metrics. This is much different. What this is telling us is that right now we have 43% of the stocks in a short-term rally mode. Okay, so that's what we're seeing here. Let me just move this up so it's a little bit higher. That's why it was kind of jacked up. Anyway, so we're seeing bullish ratios across the board as we look at this, right? So it's a massive, and I was reading wrong. This is 5,276 orders for today, for Monday. I'm sorry. I was thinking I was looking at the weekly. The weekly last 2 weeks we've had 10,502 new buys versus it's actually 12,800. I'm going to round these numbers off, and then it's about 1,000 exits. So we had a 7-to-1 buying ratio in the last 2 weeks on the short-term database. The longer-term database, even the weeklies have been 1,200. Actually, there's kind of a rotation. We've got about 1,200 versus 2,000 sells. So we're a little negative over the last 2 weeks, but it's stabilizing. And so the reason why I go through this every night is this is an important element of my analysis and helping me to get what I call what is my bias. Am I leaning bullish or bearish? This is on a short term, we're definitely bullish to trending. On the intermediate, we're neutral. And that just means a big setup range. So then we're going to go through the S&P next and talk about that. And I realized I had a really good chart up I wanted to talk about when I was talking about the employment numbers. So I'm going to show you that. It's going to be a little out of context, but I'll be able to lead us right into the weekly and daily analysis of the S&P. So I wanted to show you this chart, and this is the unemployment numbers, and I've also got the algos here. So I was trying to blow them up so you can see this a little bit. But if we were once upon a time projecting, if we go back 3 or 4 months ago, the algos were projecting that we're going to see maybe a 450 employment. I remember talking about those numbers. And what's happened here is everything's flattened out. We still have a trending as we go out. This is let me fix something. This is on daily. Bear with me 1 second. But as we come out here, this is way out in 27 where my cursor is over on the right. So, but as we look, it looks like we've got fairly stable numbers. that employment's going to stay at the worst projection is unemployment actually coming down to 395. No, at the moment, no big increase in employment happening, which is interesting. We'll see if Bob changes his forecast for the potential recession as we come into Q3 and 4. Right now, I'm sticking with it, but this is an interesting look, and the data is telling us that we're going to be stable in employment numbers anyway. And this is something that we've seen, which it's been very difficult to cover from the standpoint of being predictive in any way, because we're really looking at the if we look back, in the rearview mirror, employment, there's weekly numbers on the claims and all, everything's been so stable. It's been amazing. So you're not able to we're not seeing any increases in claims or continuing claims. And then we look at this, we've climbed up a little bit. If we go back to 23, we've seen an increase here, from around 370, 3.7 up to about 4.2. And now it looks like we're going to stabilize here. So that was going back when it was 3.7, we were looking at 3.5 or 4.5, 4.5%. And that's flattened out before we got there. So the projection higher going back last year was a valid, but we're not seeing any increases from here, which would question whether we're going to see any kind of recession or not. And probably one of the most crazy things that we've seen over the last couple of years is just the employment. And I've talked about this. I mean, the immigration across the border was really padding a lot of the numbers, but those folks are mostly still here, right? So they're still in effect there, and the employment numbers I've done this a long time, and especially if I slide this over, you can even see. I'm just going to bring this chart in for perspective. I mean, this looks like an EKG if we look back over history, and now we're seeing this bounce, and this actually brings in a better perspective, because here is 5% out in 28 is what's being projected. That's a little far out, but we are seeing, a possible. This is the echo bounces that you get off of this. It's been pretty interesting. This is 19. Just to give you, everything that's on the screen right above my head is the 1940s to current. And so you can see the big, this is the Jimmy Carter recession, 1980, 81, into 83. This is probably the first 2 years of the Reagan administration. And then big decline all the way into, this big decline here was the Clinton years, and then we get, all the craziness. This was the GFC. It says 08 to 10. So, and then you can see the spike. This was obviously the sickness days, and then all the way back basically, if you take, ends up, the entire shutting down of the economy was just that. It was just like somebody turned the light switch off, they turned it back on. If you look where unemployment came, it came right back to that point. And now we're seeing that typical bounce after these big declines. So theoretically, we could see that 5%. Let me look at here. Yeah, so these numbers are way out in beyond 26, 27. So if this forecast ends up to be right, then we have some longer term stuff to deal with, from employment going from where it is right now to 5%. And there was a time that basically anything under 6 was amazing. Okay, so perspective is everything. So, okay, let's get into the S&P now. So I've got the daily S&P. We're seeing the algos turning down. It's kind of interesting what's happening where the market grid is, there's a element that I call, it's a flat pattern that sets up. We get in, I call it a box pattern, and we're in the box right now, which basically tells us we've got some extreme values that have moved off of this low. So it's interesting because we go back to the tariff release when what was it? I forget what the day was called, but that day that everything was announced, we got that big spike and that big reversal. And since then, I think this is last week was the fourth week we've closed positive for the last 4 weeks. Let's just take a quick look. Let's bounce over to a weekly for just a second. Yeah, so this was the big spike, and then we did close lower last week, and we got an outside reversal bar working last week, which was kind of interesting. This is not a clean, what I call key reversal, but it is a reversal. And you can see the red dots. This is a weekly chart here. You can see the red dots are suggesting we're going to get back to around, and I talked about this, 5750, 5800 is a possibility in this pattern, as so we could easily continue to move higher. Let's go back to daily, and we'll just do the shorter term viewpoint. And that coincides with the improvement of the database up above 42%. It's telling us that there's stability, that there's a foundation there for short-term movement and a continuation. Now that could set the range. What we're seeing here, the 21 period moving average is right now at 5,400. We'll call it 54. So that's probably right down here is the bottom of this grid is where you're likely to be. Right now, we'll probably stay between the 40 and the 21 day. If we get above the 40, then we'll look at the extremes from the standpoint of the market grid. And I believe, bear with me, I've got one of these. Okay, this should be it. Yeah, so I'll bring this up for a second. But this is the data sheet for the S&P. Now remember, these data sheets are in all the Substack, kendallreport.substack.com. There's a 7-day free trial, $8 a month. But anyway, this is what it's telling us. It's giving us right here. I'll highlight this. It's a minor pullback. This is what is coming out of the sheet. It's giving us high target 53.62, S1. That's a different level. I'm not sure what that. There it is, 55.33, and then 55.21 is the range that's being projected. But we're looking at there's technical divergences setting up on the PPMs, and then we've got down below here the PPM1 is still in trend mode, and we're looking at the targets here of 58.83, 55.83. And as a high target for today, low target 55.21. Looks like these stars indicate that those levels have been hit, and then there's some probabilities down below here. But it's interesting that the highest probability trade is buy the dip, 55.22, target 55.83. They're setting stops based on risk reward 54.87, but there's some guidance down below, and then tells you where the strong resistance areas are. So this is actually telling us what this chart's telling us is that we're kind of range bound. Those are the ranges I was just talking about. Let me look here and just see where the values are. Yeah, 55.47. Low 55.23 so far, so it's been fairly narrow, but we should stay within those ranges. Let's go to weekly again real quick. One of the patterns that I was telling you about is this wave tech, the market grid numbers. It's interesting, both numbers on the high end and and the short end for this week actually expanded up. So the volatility what this is telling us, the volatility staying high, but the range expectations just moved up. So we've got that outside reversal. If we can get it above the 10-day moving average, it's going to be a tough level to break. We have right now the ppm 1 on the 10 is 0.89. Tells us we're going to struggle around here. We could look at the market grid on a weekly, and R1. I've really got to change these colors because I can't read them. Let me just see here. Yeah, it's almost impossible to read here. Bear with me. I got to lean over to get there. 5660, 5787. So that's kind of the higher end of that range that I've been talking about. But there's still everything right now is positive. I think buy the dip is probably the good range. You can use the market grid if you have the indicators. You can use the market grid there set up, and I'll have the fact sheets in the Substack tonight. So all those values that are down here, these histograms these are all the different levels and the probabilities of those levels being reached. Okay, so let's go ahead now. We'll be able to roll through about 36 minutes in. So we'll go to these charts, and the reason why I always start with the S&P, and I tell you folks all the time, the S&P and NASDAQ are cousins, right? So they have a lot of similar family members. The top end of these indexes are very similar, and then the NASDAQ has relatively higher beta stocks that are in this index, so it gets a little higher range built. Right now we're down 0.67, but we're flowing right along that 10-period moving average, so that you can see. Let me see if I can zoom in on this. Yeah, so you can see this downslope of this white line here. That's the 10-week moving average. We're trading right along that. I suspect we'll come down at least into this S1 target, something of that sort. So that'll probably be where the range ends up from coming down into for the week. We'll probably get at least an S1, S2 possibility on the downside, R1, R2 on the upside. And so, this will help me see this in the future. R1, 20,023, 20,547, S1, 19,086, 18,560, just rounding off. So that's your weekly ranges, right? So that pattern, like I said, it's interesting that the market grid, both the high end of the grid and the bottom end, both just kind of moved up, maintaining a pretty high volatility. So I would expect to see volatility stay very high. Who knows what we're going to hear? Like I said, the biggest news right now is probably coming out of the White House more than any of these other reports that I talked about earlier. There's not a lot of material things going on there from that standpoint. I'm just looking at a couple of comments here real quick. Yeah, I'm just looking at, I'm going to address a couple comments before we move on here. We're seeing prices starting to move up. I can tell you that Starbucks coffee bought 2 months ago at 23% more. Yeah. So that's an interesting comment, because one of the things that I think is still out there is the Amazons and the big box guys, all these players. they rate. It's interesting that it's 23%. They take the 25% number and they're probably just gouging everybody, just juicing it up. Wait till we see. What will be interesting is when we see earnings on this quarter, when we get back down the road a little bit, right? To see, my concern is that there's a lot of gouging going on too. That it just seems ridiculous how prices are, So I could argue back in the day, like 7 years ago or so, you could go to Denny's and get a breakfast for $6, and now that same breakfast is $15-16. So you're looking at hundreds of percent on that, and I just think since the illness days, I'll call it, is they just found a way to keep gouging us, and it's kind of crazy for sure. All right, so let's move on. Let's go to I'm gonna what time we got? 41. So I'll bring up the Russell for a minute. I want you to notice that the Russell pattern is much more dramatic. It's down a lot. We kind of got this reversal pattern. We got the inside bar. We got this is, by the way, this little bar pattern. I'm zoomed in on it pretty good. When you get one of these reversal, when you get a large bar, especially at the end or at the top, it would be inverted, what I'm telling you. So quick technical lesson here. When you see that, a typical next bar, and this could be a 5-minute chart or any chart's a chart to me. And when you see that bar expand like that, what you're going to see is you get an inside bar on the next bar, and then you get another outside reversal on the next one. This is like a classic pattern, but it's also kind of a climactic pattern out of a bottom. So this is setting up some kind of retest or something like that. This is RTY, but it just kind of popped out at me. Those patterns are pretty significant, especially on more on a bottoming pattern, but you watch for that big bar. I guess if I converted this over to candle, yeah, see, this is exactly why I love my bar charts, is just seeing that expansion just looks so, it just tells the story, and every chart tells a story if you're paying attention. And so just watch for that pattern. It's a 3-bar setup. We've got a 10 on, this is a Russell, we got a 10 period moving average weekly right above the action. So we might be able to challenge last week's high. Probably if we don't take that out by Tuesday or Wednesday, then we'll retrace back into maybe, I'm just looking here, maybe S1's 1926, 1886 is a possibility there. Okay, so we'll just move right on. Let's go to the treasuries, because the reason why I brought up that chart I had up earlier with the that I showed you the metrics on the portfolio. It's interesting. We've got these generally positive things going on. I talked about the database and that. Let me just see if I can go back here. I do want to show you that. This is our Smart Shield. So here's what I'm going to show you. The orders for this account. I'll blow this up a little bit so you can see it. The orders for this account is buying BND. It's buying bonds. So I'll go back to the treasuries here. And the reason why this caught me, because I'm looking, okay, we're starting to get enough traction that the ETF models are starting to kick in. No, it's buying bonds, which is interesting. And so it's allocating to bonds right now, which in my opinion is interesting. If I look at the open positions on this this strategy right now is zero. We've been out of the market, and I think if I look at the performance right now on this, it's year to date, it's down 0.5% because these models are set up so you get out of the way when the train's coming down the track. You don't want to stay on the track, get off of it. So this is one of the things I've been telling you folks. Like people are always telling us, my world exists here where we have over $15 billion being managed yet in this project. Used to be 200 back in the day, in the good old days, as they say. But the point is that this is what this strategy does. It gets you to cash and protect. Like I said, going back to the orders, this order coming out is buying bonds. Okay, so let's go back to the treasuries here. So when we start to look at treasuries here, you can see the projection is for bonds to move lower out of this pattern. We got this is a weekly chart. I'll go through the indicators here in just a second. But what we're getting here is that there's that big reversal, but in this case, we're getting the inversion. We get the inside bar. Now, last week we took out the low of the inside bar, so this is week 3. This won't be reflected till tomorrow's opening. But the pattern here on a weekly is suggesting that we're going to see a bit of a contraction. So we look at the indicators, and nothing really drastic, but a gradual flow to lower rates. And I set this up a couple of times last week, as what I'm looking at is a range of worst case, a best case, we'll say 390, and on the upside, a 440 range. And we're just going to narrow in on that range. Right now we're 425. Maybe we're going to print down to 415. I think we stay above 4 no matter what. But this is kind of interesting. Like I said, the WaveTech is picking up on whenever WaveTech issues a buy signal, it says there is a very strong probability, it wouldn't buy if there wasn't, of an appreciation of that asset, no matter what the symbol is. In this case, it's bonds. And that's what kind of triggered me to look at that portfolio and then show you these portfolio metrics. If I can get, I always get the wrong one. Here we go. But those metrics are what are important. I just realized it's right here. But these metrics here, it's already telling us. If we go to the volatility page here, it's already telling us that the volatility has drastically been adjusted here. So now we're going to bonds. So we're not going to equities, even though we're seeing the short-term models kick in. We're seeing all of that kick in, but it's not really coming through here. Let me just see if we can get this back up here. So yeah, so we're just seeing all of this stuff coming, the stories being told, and we're seeing this come into play. All right, so let's go to gold. Gold is looking, this is a weekly. I think it's finally setting up at least a consolidation. We're seeing the algos starting to look like it's going to come off here. But this, I've shown you this chart before when it's blown up. This angle of attack is huge. And this is a weekly. So the 10 period, it will take until probably the end of May before the 10-week moving average will be a factor, and most likely what we're going to see here is just a consolidation. So let me draw some things in here for perspective. So what should happen here with this market grid, just like with the others, we need to, this little blow up in gold that went 2,900 to 3,300, this needs to be, this bubble needs to consolidate and get into a range. Meanwhile, we probably trade in, I'll draw in some bars here, we'll trade within this volatility, and most likely even the probabilities will be that this 10-period moving average will be basically the floor of this trend. So we should set up bars that end up trading in a range. So I don't suspect to see, we still have live Fibonacci's. I'll bring up the numbers here. Well, I've got them here. So this line up here is a Fibonacci 2 button. That's 3664. That's still a live projection, but the way the market grid is set up, and I'll take all this off and we'll go and do we'll put the indicators back up. You can see the indicators are all suggesting that we're going to see a burning off of this big momentum because it's way overdone. The charts are in good position here. I'm going to come up for a second. I want to see, I keep telling you folks, I'm going to show you this chart, and I'm working on a better chart. Hopefully I'll find this. I think I'm down the same rabbit hole I was down before. Yeah, I am. So just come back up. I promise you folks, matter of fact, maybe I'll put something in the Substack tonight, but what I was going to show you is this angle of attack and the numbers, the math behind the angles of attack. And I was working on putting some things together and more of a clearer rule base together, especially those of you who have the indicators, and you can therefore have a little better math behind those things. But from this standpoint, we're seeing that volatility bubble, things should contract. We're going to have a wide range. I mean, if you just look at the range here on just for, this is a weekly range, right? Let me move this over. You'll see over on the side here, the range is 3,098 to 3,561 within the volatility range. And we're probably going, I didn't run a sheet, but it will be in tonight's Substack. But you're looking at, R1 3384, S1 32, maybe a 3214 at the lower end of things. So, yeah, that's on a weekly projection. So I'll do a real quick. Yeah, this is gonna work out perfect. We'll be right on time here. But if we look at the daily charts here, you can see this short-term momentum collapse happening a little more quicker, and this is the same pattern, by the way. Same thing that has to happen. I was showing you that big bubble on the weekly charts. The dailies are already started this process. So you're seeing that the market grid will close in, and once it closes in, that is where I talk about that the ranges and the volatility has normalized. Once it's normalized, then that's the point I've given you folks this half pipe suggestion, is that's the point where you start to break out and volatility increases. So what you're seeing within trends, the ups and downs, you get volatility increases, normalization, consolidation, and then another expansion, and it happens on both directions, up or down. In this case, with a big strong uptrend on the weekly and the daily, you see all of these angles are still up. All that's being projected right now is sideways movement into even the 21-day moving average. We're looking at 3340, 3325, probably a range. It could get a little more drastic than that, but that that envelope on those WaveTech market grid are going to collapse in. And once they collapse in, that's where the rubber meets the road. That's where you're going to make your money. You could probably do, option strategies. You can just sell calls, sell puts here and take in that volatility and sell out of the money stuff, right? And then what you'll see is that that contraction normalization, and then that's the point where you're able to make the next call for a market. Sometimes when you're like what we were in, if we go back here, back into April, you just had this massive moonshot happening. When that happens, there's never. Let me just bring up the indicators. You can see even, and I remember talking about this a bit back, is everything was forecasted to be explosive to the upside, and we got it. We also went into the daily Fibonacci targets. All those things happen. So just know whenever you're looking at a chart, and the reason why I developed those market grid indicators was a couple reasons, but one of the reasons was identifying that expansion normalization. And then with the indicators, you can start to look at when that's compressing, not only what the indicators are in value, but the forecasts will help you to define that. So that's the best way to go from there. So let's do Bitcoin, and then we're out of here. So Bitcoin kind of got, if we look here, this is daily charts. Momentum's bleeding off. Looks like it's going to bleed off into through this week, maybe early next week, at least into the 4th or 5th of May. And then you look at the moving averages, we're seeing that contraction as well. We didn't get a big bubble here, but let's go to the weekly because there's a bit more of a, if you look here, I'm going to go back before I move on. Tuesday on the 22nd, we closed above the market grid, and that signals sideways 1 to 2 days. Sometimes it'll do more. So that was pretty much that close on that extreme that day was the point where the market just flattened out. Did make a slightly new high, but basically you see the market grid start to flow over, and it was a little expanded, not that much, but now it's getting close to contracting, maybe even starting a little downtrend, and maybe we come into back to the 200-day, and then that's another point to trade off of that level. Let's take a quick look at the weekly, and we will be spot on an hour here. Yeah, so weekly, this was, we've got actually a nice little trend going from the standpoint, we've got a channel that's formed. Let me just blow this up. So we got a potential channel. I suspect after this week, we'll see that same contraction normalization mode, and we'll come into these moving averages. The red dots were forecasting closing days out into the future, are suggesting we're going to stay around this 9,600. And there's always a possibility when you're in this type of configuration that you start to break over 100, you get a stampede and this thing takes off. But right now the forecasts are, we go to the weekly charts here real quick. Forecast is still bullish on the short term, so there's still relative upslope. So anything off of the 10, this is a weekly 10-week moving averages is super value here, which right now that's probably going to come into play. That number right now is at 86,000 even, we'll call it. Okay, that would be like the best buy you're going to get on Bitcoin at the moment. And that, we're trading up at 93, so that's a pretty good buy. But that's extreme. We'll probably have another value in here around 92.5, and I'll lay that out into the Substack tonight. Okay, folks, we'll call it quits here. We're right 15 seconds to the hour, so pretty good timing tonight. Let me look at a couple comments before I go away. Okay, I'll see if there's anything that stands out. Yeah, JH, maybe that was me. Let's see here. Yeah, it just looks like there's a couple comments. I'm just reading through some of this stuff here real quick. Yeah, I would agree. Sell the rips, but you can also buy the dips intraday. There's a lot of stuff here. I'm just looking through here. Yeah, that's interesting, Chi-Town, Tony. And those are on daily signals, yeah. So they're probably a little noisy on the IWM and SPY. It buys on daily for Monday. That'll be interesting to play out. Yeah, Ed, Woosley, I would agree with the Trump comments. That's pretty much all that matters right now. All this other stuff is immaterial. Just to close out, in my opening comments, I was talking about how the Japan deal may be the model for going forward with everybody else. If they get a deal, they claim they're close, whatever that means. A lot of this stuff is just rhetoric that is coming out of the White House to keep everybody waiting and not acting. So hopefully they get a deal. It's a good one. And it's also something that can be modeled going forward with, like I said, there's a core group of countries. If you X out China, it's pretty simple. There's probably 7 or 8 major entities that you need to deal with. Japan, India, probably, I think Taiwan's is sort of kind of done, but they have different needs from the U.S. than other folks, but a lot of the Asian countries as well. So it's going to be interesting to watch and see what happens as we go forward. All right, folks, thanks for watching. I'll be back tomorrow night, same time. Don't forget to get the Substack, kendallreport.substack.com, $8 a month. Get a 7-day trial. I get the data sheets. I got some other stuff that's going to be coming to the community as well that I'm very close to releasing. So anyway, thanks again for watching. We'll see you tomorrow night, same time. Hey, Chi-Town, yes it does. That's why those are probably bad signals. Sorry for the echo. Doesn't mean it's not a good trade, though, even though the ER is low.